Jason, what you started, the thing that I have struggled with the most in these last few weeks is trying to come to a conclusion on inflation. My worry is that it's here and it will be persistent. And inflation comes in two ways. Way number one is if you massively increase the supply of money. Why? Let's just say the economy had $100 and now all of a sudden you just print another 100, so now there's $200. What will happen is all of the goods and services that make up that 100 will get repriced to absorb the 200. So prices go up, inflation goes up. The second way that inflation can happen is if middle and lower income people buy and spend. Because when rich people have extra money, they just buy financial assets. That's why you get financial bubbles. But practical goods and services are bought by average, everyday, normal working folks. And their wages are going up. And so I think what we've created is a really distortive inflationary cycle that's going to really hurt the United States because, as Sacks talked about, we cannot print enough money to pay for the debt when interest rates go up.
This is the number one thing causing me concern as well, is that you look around, it's all-time highs for everything. It's all-time best everything. NASDAQ and S&P, all-time highs. Crypto markets, all-time highs. Shibu, Inu, worth $30-40 billion bubble. I'm seeing SaaS multiples. Real estate. I'm seeing SaaS multiples at all-time highs. Crazy. And so you have to wonder, is this a new normal? Is this sustainable? Or is it some sort of inflated bubble? Then you look at the inflation rate's 5.1%. To Chamath's point, it might be persistent. You look at the Treasury interest rates, the yield is 1.6% on the 10-year T-bill. Okay, so effectively, your real interest rate for savers is 1.6% minus the 5.1% inflation rate. You're at negative 3.5% if you just save your money in T-bills, in sort of risk-free, you take the risk-free return, negative 3.5%. So now you have everybody going out there trying to chase a yield, because how do you earn a return on your money? You don't want it to be
you buy stocks or NFTs or houses.
So people start going into riskier and riskier assets to basically try and make up for the loss of inflation. And so you have to wonder.
They're trying to hit the one-outer.
Yeah. So then, okay. So you have to ask yourself, okay, so back to this point about all-time highs, is this because everything is really this great, or how much of this is driven by these sort of distortions?
50-50. I mean, I'm just putting a number on it. Like, obviously the industry and economy is doing fantastic, but it seems 50-50.
Here's the other thing that I wanted to make in just the last portion, which is, I think what we've realized as well at the end of this is, I actually, again, now to use this empathy card, I'm going to give the progressives my empathy card and say, I understand what you're trying to do. And I believe in a lot of what you're trying to do is to even the starting line for everybody. Right now, a lot of what you end up proposing distorts that goal by trying to, even out the outcomes and even the finish line. But I really do think they want to even the starting line. But here's the thing that we all have to realize now. All the things that the progressives want to tax and fund are actually being done by private corporations. And I think we just have to acknowledge that and make a decision about whether as a society that's okay or not. I'll give you two examples. Number one is the federal minimum wage. We have tried for years and we have debated raising this minimum wage. It still sits today at $7.25. Just this week, McDonald's moved their minimum wage up. Starbucks moved their minimum wage up. We're talking about, entry-level quick service jobs that now pay $17 to $25 per hour. Right? So 2.5 to 3+ times the proposed federal minimum wage.
The free market worked.
And so what government didn't and wasn't able to do, the free markets have done. Second example, we tried to get free community college inside of one of these bills. It was dropped. Now, depending on where you go, the nation's largest employer, Amazon, actually will just pay you to go to college. Right? So they are replacing that intention and a version of the GI Bill, but as a private organization. So I think what we also have to realize is that maybe some of these policy decisions is actually a little bit of, getting tilted by the fact that private organizations are acting more nimbly to actually implement this progressive agenda, because it actually exists in America if you're willing to take the time to look.
Let me ask a question about inflation. Who is inflation going to hurt the most and who's going to gain the most from it? Because it does seem like consumables, gas station, supermarket trips, et cetera, are going through the roof. In that case, that's going to have no impact on the top third of people because a gallon of milk at $3, $6, $9 doesn't matter. But then you look at inflation on stocks, it's going to make it go up. So a rich person isn't impacted by their gas or their groceries, but somebody in the middle class or who's poor, that's going to dramatically impact them. So if we spend more, does that actually create a larger wealth gap? Sacks?
Look, inflation is devastating for the middle class. If you have savings, if you can afford to put all of your savings in financial assets the way that the super wealthy can, then your financial assets will go up. But if you have a good sort of middle class income and you don't have your savings or in something more conservative, you're going to get absolutely eroded by inflation over time. It's going to kill you. And housing prices will go up. The middle class young couple that wants to buy a house for the first time, that's going to be much harder to achieve because housing prices will inflate away. So I think there are some effects that are a wash. So, for example, prices go up and then wages go up at the same time. But savings can really get hammered if you're not in financial assets.
It hurts the middle class first, but it also hurts everybody because, again, unless you're perfectly hedged going into a rising rate environment, you will own assets that are just speculative and get crushed.
Friedberg, a scientific question here. Are we starting to go into a self-fulfilling prophecy around inflation, a la what happened in the 70s, which is we've been talking about it so much that anybody who is thinking about raising prices says, well, everybody else is raising prices. So even if my grilled cheese sandwich hasn't been impacted by all of this and I didn't have to give raises to my employees, they're happy at their current salaries, I'm just going to put $2 on my grilled cheese. And we just get this cycle of everybody saying, how much can I add to the cost of something?
I am trying to remember. There was an earnings interview I saw yesterday. Which was the company? Anyway, they're a company in the industrial supply chain. And he said that they're raising rates to get ahead of the supply costs going up for them so that their margins won't get squeezed. And I think that's it's almost like that. What you're referencing is a little bit of a run on the bank mentality where those with pricing power raise prices. And as a result, you end up kind of seeing the trickling effects because competition can't catch up. So if everyone's kind of raising rates and there's not enough competitive advantage, the one thing that's making this even harder right now is the gluts in the supply chain, which are reducing the competitive market dynamics that we might normally see where one company raises rates and another company says, wait, our rates are going to stay the same. But because so many people are challenged by getting product, there's enough demand for their product, everyone can raise rates together. We're seeing this in the energy markets now. So, this is kind of part of the scary scenario that everyone's trying to manage against. So I don't know what the science is, and I'm not an economist, but it certainly seems to me like the psychology of managers and business owners and boards is such that they're saying, let's get ahead of the curve, let's raise rates. And as a result, you're seeing the trickling effect of inflation throughout the whole economy. So a little scary.
Sacks, what do you think psychologically is going on with raising prices? Yeah.
So expectations are definitely part of the inflation game. People raise prices if they expect inflation in the near future, and then that feeds on itself. And that's how, if you look at countries that have had hyperinflation, that's how you get a spiral. Now, I don't think we're going to have hyperinflation here, but we're at 5.1% now. And if people think it's going to be worse next year and the Fed's not going to raise rates, it could even be higher next year. And I think people are going to start getting upset about this. When they buy their Thanksgiving turkey and their Christmas ham, and those prices are way higher than they think, and they're already paying gas prices that are a lot higher than they're used to. I think you could see a lot of unhappiness out there.
One other thing I'm thinking about is the logical thing for a person to do in this hyperinflationary, market is to say, you know what? I went to look at a car that I wanted to get to drive in the snow. And I was like, you know what? I'm just going to hold off buying this because I'm not paying $15,000 over sticker. So, and I can pay $15,000 over sticker. So I was like, do I want to do that? The other car's okay. I'll just put snow tires on it. So are a lot of people, Chamath, then as part of this psychological, spiraling out of control situation, then some group of people might say, you know what? I'm going to opt out of consumerism and I'm just going to lower my burn rate and stop consuming, which is also bad for the system.
How are you going to stop consuming food?
No, I mean, food
prices are going through the roof.
Inflation, instead of getting, filet mignon, you might get chicken.
Okay, well, there's going to be a lot of unhappy people who are eating chicken for Christmas instead of filet. I mean, serious.
I'm coming to your house, so I'm getting filet, so I'm good. I'm going to go to your house for lunch, and I'm going Chamath's for the surf and turf after.
Guys, rich people don't create inflation. The middle class and the lower middle class create inflation. There's just not enough rich people to matter. They're irrelevant. So when you look at the last 2 or 3 spikes and waves of risk that we've seen globally, they've come from large multi-hundred million person cohorts of people, right? Those could be in Asia. Those could be specifically in China. Those could be in the United States plus all around the world because of certain loose monetary conditions. That's what we have now. We have a multi-hundred million, probably approaching more than 1 billion person strong liquid buying pool of people that are, again, as I said, if the lowest on the pecking order is now making $17 an hour, we all know this, guys. It's not as if the inflation stops at $50,000 a year. Everybody's wages rise. So consistent and persistent wage inflation will allow you to spend more because that's just what people do. We also have high savings rates, so people will feel more flush with money. The point is that everybody will spend. They will spend more. You can't get cars. You can't get this. You can't get that. All this pent-up demand will get fed. And the downstream implication is I think that prices will rise, but it will disproportionately hurt the middle class and the lower middle class. And then these asset bubbles will probably deflate, or they'll have to get re-rated. And if the Fed stops tapering and, hikes rates 2 or 3 times over the next 12 or to 18 months, man, this is an ugly, ugly stock market.
One of the things people have been asking me to ask all of us on the pod is, what are our strategies right now, given the turmoil we're in? So maybe we can go around the horn and what we're thinking about in terms of our strategies to deal with inflation while maybe not getting ahead of our skis and being the bag holders. Anybody have? I'm not going to
answer this question, and you know why? Because I can't.
Got it. Okay.
Because of the public market, I don't want to even answer this question yet.
Okay. Well, let me further describe the problem. So this happened in the late 1970s. We had stagflation. We had sort of every year we had increasing inflation because of the expectation game. And the thing that broke it was you had Paul Volcker come in at the Fed and he jacked up interest rates, and he actually caused a pretty severe recession in like 80. I think it was like 82, 81, 82. I think by 83, we were coming out of it. And then the economy absolutely boomed. Interest rates came way down because he broke the back of inflation. And actually, interest rates came down for, as a result of Volcker and the Fed controlling inflation, they came down for 40 years, basically. And that decrease in interest rates fueled everything. It made debt a lot cheaper. It made the stock market boom because the net present value, the discount rate went down, so the net present value of all those future earnings went up. So you had it set the stage for the boom in the Reagan era and beyond, and the Clinton era as well. Now, what's the difference between then and now? Well, for one thing, the government debt as a percentage of GDP when Reagan took office was around 31%. Okay. So when Volcker jacked up interest rates, it didn't really create that much more of a debt service cost for the United States, for the federal government. Now, today, the government debt is 125% of GDP. So and this goes back to the Druckenmiller point from previous pod, if the Fed were to jack up interest rates to say the historical norm of 4.9%, debt service would go from 2% of the federal budget to 30%. You would have a massive crowding out of government programs. So how we fund all that debt service, very unclear. So we're caught between a rock and a hard place. The rock is we have inflation that could be persistent. The hard place is the debt service. So, the tools for controlling this aren't exactly clear. So this, I think, is fundamentally the problem is it's not clear whether we're going to have interest rates going up or persistent high inflation. Those are the threats to this sort of economic boom we're seeing. Now, the flip side of it is that the reason why the stock market is one of the reasons it's at an all-time high is because earnings right now are fantastic. So the economy is the companies are doing very well, but we just had for Q3, the GDP growth was at 2% annualized, which was sort of an anemic number. It's the lowest it's been since this COVID recovery started. So it's, it's interesting. We're at all-time highs, but there's also these like major storm clouds on the horizon. And I'm not going to like pretend like I know what's going to happen. I just, when things are this good, I start getting nervous. When it's this easy to make money across everything, the stock market, the crypto market, the SaaS investing we're doing,
we know we're on a heater.
Can I just say that's the part that really scares me. So for example, when everybody gets tilted because there's some Shiba wallet where 8,000 turns into 5.7 billion, right? So for those that don't know, there was a Shiba Inu coin, which is a shit coin, which was basically there to ape
the other shit coin, Dogecoin,
the Dogecoin, right? A meme coin. All of a sudden, some guy 13 months ago put 8K into it because the whole market cap was 80K. And then all of a sudden, over the course of these 400 days, that wallet holds $5.7 billion of value, or 10% of the entire market cap of Shiba. People get tilted by that. Then there was an article today in Bloomberg where there's a gentleman, a 66-year-old man in Singapore, who's a billionaire, right? So he was successful in his own right. However, he had made in his entire career about 1 or 2 billion, and he has made 7 billion in the last 2 years speculating on Tesla call options.
Wow.
I'm not kidding. So buying short-dated calls, right? Riding the wave, making money, allocating the gains, buying the underlying Tesla security over and over and over again. And so, I was talking to Nat about this, and I was telling her these examples, and she's like, that's what sounds like a bubble. Because it really is very difficult to be in business and to make these decisions and to be reasonably
and also,
right.
If you're a capital allocator or you're building companies, like, how do you know if you're doing a good job if everybody just is?
I'm going to be right back, guys. I have to deliver the goods.
Yeah. Okay. We've got a quick baby change.
I think what's hard about this is, okay,